We are currently in what financial analysts refer to as stage 5 of a market cycle. This isn't just a matter of opinion or speculation. It is a conclusion drawn from careful analysis of recognizable patterns that repeat over time. When history tends to repeat itself, and it almost invariably does, this stage 5 indicates we have approximately 18 months remaining before the market reaches its lowest point, or what is often called the bottom. In other words, from this point onward, if the pattern holds true, we could expect the total collapse of the market within roughly 1.5 years. Reflecting on the past, particularly the stock market crash of 1929, we see that it took exactly that same amount of time, 18 months, from when the smart money first identified the developing cracks until the Dow Jones Industrial Average lost nearly 90% of its value. Such clarity in the timeline allows us to track every transitional phase because the underlying pattern remains consistent. To illustrate, let us revisit the specific timeline from the unprecedented high of September 1929, which marked the beginning of stage 5. At that time, the stock market was at record-breaking levels, reaching all-time highs across the board. Investors were under the illusion that these heights were sustainable indefinitely, a misconception that proved dangerous. During these days, informed insiders quietly began to sell off their holdings, recognizing signs of impending trouble. Margin debt, borrowed money used for leverage, had escalated to approximately 8% of the country's gross domestic product, a level that historically signals over-leveraging and imminent risk. Meanwhile, valuations of stocks had become detached from the fundamental earnings they were supposed to represent, creating a clear disconnect between price and actual corporate performance. The mathematical models analyzing these factors left no doubt as to what was coming next, making the crash almost an inevitability. In October of the same year, 1929, the first signs of cracking surfaces appeared. Initial liquidations, panic sales, and a wave of selling that marked the beginning of serious trouble. As November and December unfolded, markets experienced false hopes, characterized by temporary rebounds and what traders called dead cat bounces, which only provided brief relief before the decline resumed. From January through June of 1930, the market entered a slow, relentless downward drift, eroding wealth gradually. Then, in July through December of that year, the decline accelerated rapidly, with the collapse becoming increasingly severe. By January of the year following the crash, and continuing into March, the process of capitulation began, investors giving up and selling at any cost. By March of 1931, exactly 18 months after Stage 5 commenced, the Dow had plummeted from a peak of 381 points to around 160, representing a 58% decline. However, this was not the final bottom. Further losses transpired. The market continued to fall until it reached an even lower point, 41, almost 2 years later, which marked an overall loss of almost 90% from the peak. Notably, the critical point where most of the damage had already been inflicted was approximately at the 18-month mark, when fortunes of countless individuals were destroyed and the middle class was devastated by the economic upheaval. Fast-forwarding to the present, November of 2025, we find ourselves seemingly in the very same Stage 5 moment that preceded the 1929 crash, September of that year. The indicators today are alarmingly similar. Insider selling is reaching record levels, indicating that those with privileged information are cashing out. Margin debt, which remains dangerously high, is approaching the equivalent of 8% of the country's gross domestic product. Warren Buffett, one of the most renowned investors, is currently holding an enormous cash reserve of approximately $325 billion, an unmistakable sign that he perceives an imminent downturn. Valuations across the market are disconnected from fundamental financial metrics, making no rational sense under normal economic conditions. All these signs suggest that the most astute investors are already retreating, pulling their capital out of risky assets. This convergence of warning signals signifies that we are once again entering the crucial 18-month countdown. If the historical pattern persists, as it has in every previous cycle, then the final collapse could occur around May of the coming year 2027. During this window, most of the wealth accumulated over years, if not decades, will likely transfer, almost involuntarily, From those forced to sell their assets due to mounting losses to those better positioned, those who buy at suppressed prices and wait for the inevitable rebound. To understand how this pattern unfolds, I will now walk you through the month-by-month progression from September 1929 to March 1931, aligning that timeline with the projected period from 2025 to 2027. This exercise will highlight what to watch for each month as signs of market distress become visible, when selling accelerates, when fleeting hopes emerge, when genuine capitulation occurs, and, most critically, when you must make decisive moves if you intend to survive the impending crash. Because it's vital to recognize that such a market decline isn't a sudden event that concludes in a single day. It's an 18-month process of systematic destruction of wealth, eroding fortunes over time with increasing severity. The countdown commenced on September 3rd, 1929, when the Dow Jones Industrial Average closed at exactly 381.17, its then record peak. That peak would stand as the highest level for a quarter of a century, and at that moment, almost no one anticipated what was impending. Media outlets remained bullish, investment advisors urged clients to buy more, and the general sentiment was overwhelmingly optimistic. Irving Fisher, considered America's most respected economist at the time, was delivering speeches about a permanently high plateau, confidently asserting that the market's lofty heights would endure indefinitely. Yet, very few individuals recognized the warning signs. Only a handful grasped the dangerous mathematics underlying the over-leveraging and speculative excesses. Among those few was Joseph Kennedy, one of the decade's most successful speculators and investors. Recognizing the signs of an impending crisis, Kennedy began liquidating his holdings well before the crash. His understanding of the mathematics behind margin debt, where investors borrow money to buy stocks, was precise. When nearly everyone operates on 10% margin, a modest 10% decline can wipe out their entire equity. Once their investments are wiped out, brokers are forced into liquidation, triggering a chain reaction of selling that accelerates the market's downward spiral. This early wisdom proved prescient, foreshadowing the chaos to come and revealing the importance of paying attention to the subtle signs of systemic risk. When market brokers are forced to sell off their holdings during a downturn, it triggers a further decline in stock prices, creating a self-perpetuating cycle of falling valuations. This decline feeds into itself, intensifying as more sellers rush to liquidate their positions, which in turn drives prices down even further. Once this downward spiral begins, there is often no stopping it until all borrowed money, leverage, has been completely wiped out or forced out of the system through various means. In this context, Bernard Baruch, a seasoned investor with a wealth of experience in recognizing financial bubbles, has also exited the market. By September, he had converted most of his assets into cash and government bonds, safeguarding himself from the impending storm. Baruch had witnessed similar bubbles and financial panics in the past, and his insights are rooted in history. He recalls the panic of 1907, which shook the financial world in the early 20th century. He is well aware of the typical early warning signs, the manic conversations, the almost religious fervor among investors, and the dismissive attitude toward skepticism, all characteristic signals that warnings are being ignored and that a collapse is imminent. It is always the same pattern. Exuberance reaches a fever pitch before the inevitable crash. Meanwhile, money is fleeing from Europe as well. British financial institutions, in particular, have been quietly offloading American stocks since August, recognizing perhaps the earlier stages of a bubble. These banks and investors have seen similar scenarios unfold before, such as the infamous South Sea bubble in 1720, which burst after years of wild speculation, and the railway mania of the 1840s, which also ended disastrously. They understand deeply that when company valuations detach completely from the real financial fundamentals, when the valuation multiples no longer reflect actual earnings, and when speculation becomes widespread across all sectors, that moment marks the most dangerous point of all. Corporate insiders, those who hold the most intimate knowledge of their own companies, are also behaving suspiciously. They are systematically unloading large portions of their holdings, 50, 60, even 70%, not as a diversified strategy, but as a clear sign of their awareness that stock prices are detached from the true state of their businesses. These insiders recognize that the earnings generated do not support the lofty valuations, which are now just a product of unbridled speculation and investor optimism. They are capitalizing on the current market highs while retail investors cling to the false hope that their investments will continue rising indefinitely. Now, an important detail almost nobody seems to notice or fully comprehend it is that corporate earnings reached their peak during the second quarter of 1929. By September of that year, those earnings had begun to decline. Factory orders were falling, industrial production was slowing down, and commodities, raw materials and goods, were losing their value across the board. The real economy, the engine fueling corporate profits, was already beginning its descent. Yet, despite these clear signs of economic slowdown, the stock market kept climbing, seemingly disconnected from the tangible economic conditions. This divergence between the dwindling reality of economic fundamentals and the rising stock prices is the hallmark of what is often called stage 5 of a bubble. At this stage, prices are driven solely by collective belief, by momentum, and by the assumption that the trend upward will never end. What has gone up will continue to rise indefinitely. Currently, in November of 2025, we find ourselves in this very situation. The Dow Jones Industrial Average and the S&P 500 Index are near their all-time highs. Warren Buffett, the legendary investor, holds a staggering sum in cash, more than $325 billion, a level he has never possessed before, indicating perhaps the readiness for a decisive move. Meanwhile, corporate insiders are selling their shares at levels of activity unseen since 2007, right before the last major market crash. Margin debt, borrowed money used to buy stocks, is approaching record-breaking proportions as a percentage of the gross domestic product, further signaling excessive speculation. Additionally, corporate earnings are, or at least appear to be, showing signs of weakness, following the same pattern as in 1929, the same stage of an impending collapse. Reflecting on the events of September of 1929, it is clear that that period marked the final stage 5, when euphoria and complacency gave way to sudden and dramatic failure. The current situation in November of 2025 mirrors that historical pattern precisely. The countdown, measured in months for many, has now begun, and with that, the tension in the markets grows. October opened with a sense of nervousness. The trading sessions were choppy, with some days ending with gains and others with losses, but the overall trading volume was exceptionally heavy, extremely so. Professional traders recognize what such high volume typically signifies during a mature bull market, a process called distribution, where informed money begins selling to less informed investors, often termed dumb money, who continue to buy into the illusion of perpetual growth. Then, on Friday, October 18th, the market experienced a sharp decline, a sudden drop that caught many off guard. Although it managed to recover somewhat by the end of the day, there remained an undercurrent of something different, a hint that the just-resumed rally might not last long. The following Monday, October 21st, saw further selling, and on Tuesday, October 22nd, the trading volume increased dramatically, with prices continuing their downward slide. By Wednesday, October 23rd, panic truly began to set in among investors. In the midday hours, a group of leading bankers, juggernauts of the financial world, gathered at the headquarters of J.P. Morgan. The assembly included luminaries such as Thomas Lamont, Albert Wiggin, and Charles Mitchell. They announced the formation of a pooling effort, a collective attempt to stabilize the market by buying stocks en masse. Through a coordinated effort, they purchased shares, which temporarily halted the fall and provoked a rally into the end of the trading day. Over the subsequent Saturday and Sunday, the newspapers eagerly proclaimed their supposed success, trumpeting the so-called rescue of the market from imminent disaster. Certainly, here's a richly expanded, polished, and coherent version of the provided text, developed into a more detailed and flowing narrative while preserving all the essential facts and key points. The financial community was momentarily saved by the quick actions of the bankers, who managed to contain the initial panic. At that point, the situation was merely a disturbance, a temporary ripple in the ocean of the market's otherwise stability. Everything appeared to be under control and heading back to normal. However, beneath this surface calm, the machinery of chaos was quietly brewing. Over the course of the weekend, Thousands of margin calls, urgent demands for additional collateral, were sent out through the mail to investors who had borrowed heavily to finance their trades. These calls signaled that trouble was brewing beneath the surface, ready to erupt when the new trading week began. As Monday, which was October 28th, approached, the market was poised on the brink of upheaval. Traders began to sell off assets en masse, driven by a sudden surge of fear and uncertainty. This relentless selling pressure caused the Dow Jones Industrial Average to plummet sharply, by more than 13% in that single day alone. It was a staggering decline that sent shock waves through markets worldwide. But the breakdown was far from over. The very next day, Tuesday, October 29th, famously known in history as Black Tuesday, the trading volume exploded as more than 16 million shares changed hands in frantic attempts to liquidate positions. The Dow continued its descent, losing another approximately 12%. In just a span of 2 days, the stock market had most likely experienced a loss of roughly 25% of its value from the recent peak. This rapid and severe decline marked a significant upheaval. Yet, it is crucial to understand that this event was not the ultimate market crash. Instead, what we observed was the beginning, the first cracks appearing in a seemingly solid edifice. This phase, often called a crack, signifies the moment when forced selling, investors being compelled to liquidate their holdings, begins to accelerate. It is also the time when high leverage, borrowed money amplifying gains, begins to unwind, setting off a chain reaction that intensifies the decline. What unfolded over these days was only the initial stage. The worst was yet to come. What I have just described is what the public sees, the widely acknowledged timeline of events that dominates headlines and mainstream discussions. But beneath this overt narrative lies a subtler, almost invisible layer, a secondary timeline, one that very few people are aware of or talk about openly. This hidden timeline reveals what the smarter, more experienced investors, often referred to as the smart money, are truly doing behind the scenes during these critical moments. This secondary timeline encompasses the critical indicators these savvy investors monitor constantly. It involves the sectors they start to exit before the masses become aware and the specific positions they begin accumulating in anticipation of the next move. Understanding this clandestine sequence is vital because it offers insights into where the market is heading next, an advantage that can protect or even greatly multiply your wealth if acted upon wisely. Recognizing the importance of this unseen perspective, I have developed a special, private series called The Hidden Timeline, designed solely for channel members. In these exclusive videos, I am able to share critical information that, for legal reasons, I cannot disclose publicly. This series reveals the signals flashing just before every major market crash, areas of the economy that are about to buckle first, and the strategic moves being made by institutional players, which often serve as early warning signs. There are 2 levels of membership available. The first, called Insider Access, involves a modest fee of just $3 per month and grants you entry to bi-weekly updates, specifically every Monday and Thursday, where you can stay informed about the evolving hidden timeline. For those seeking a more comprehensive view, receiving detailed reports, in-depth research, downloadable PDFs, and exclusive videos that expose what the mainstream media cannot or will not reveal, the highest tier is the Empire Circle. Membership at this level provides unparalleled access, including monthly reports, private analyses, advanced data sets, and premium videos that unfold what's genuinely happening behind the scenes of the financial world, insights that are legally sensitive and therefore kept from public release. The next private report for Empire Circle members is scheduled for this coming Thursday. It will delve into the true institutional positions and allocations for the weeks ahead, offering vital clues for anticipating the next phase of the market cycle. To gain access, simply click on the provided link, select the Empire Circle membership option, and you will be granted immediate entry to this exclusive content. When the inevitable market crash occurs, having access to this information will not only safeguard you, but will also put you at an advantage, allowing you to navigate the turmoil with confidence and even profit from it. Based on current patterns and historical trends, this event is expected to unfold sometime between November and December of 2025. More specifically, The first significant crack in the system is likely to appear within the next 30 to 60 days, possibly triggered by a major bank failure, a heavily anticipated company missing its earnings target by a wide margin, or a sudden geopolitical shock. In reality, the specific trigger is less important than the overarching fact that the entire financial system is now so highly leveraged and fragile that even the smallest shock could ignite a full-blown crisis. Watch carefully for these telltale signs. First, a sharp decline in the market, down 3 to 5%, in a single day, which, while not unprecedented, would be highly unusual at that stage. The following day may see a modest recovery, as large institutional players attempt to stabilize the situation. But then, the downward trend resumes, this time more aggressively, 5 to 8% drop, before culminating in the critical event, one day, or perhaps over 2 days, where a decline of 10 to 15% unfolds. This scenario represents the fissure, what will be remembered as Black Thursday and Black Tuesday, the points of no return. It is essential to understand that what appears to be a low point does not mark the end of the downturn. Instead, it signifies the beginning of what could be an 18-month-long decline. After this initial crash, an unexpected phenomenon often occurs: a pause, a temporary stabilization of the market. From early November into December, prices may rebound slightly, bouncing around without significant further drops. During this phase, the Dow might sit roughly 30% below its previous peak, but the market remains surprisingly resilient, refusing to collapse further. The reason for this temporary stabilization is largely psychological. Investors, sensing that the worst may be over, start to believe that the correction was necessary and that stocks now represent attractive value. Newspapers and media outlets depict the downturn as a healthy correction, an essential cleanse for an overinflated market, and investors are lulled into a false sense of security, believing that the worst has passed. Let me know if you'd like any further adjustments or additional elaboration. In the world of investing, seasoned advisors often tell their clients that a particular market decline presents a golden opportunity to buy. The rallying cry is to buy the dip, encouraging investors to take advantage of what appears to be a temporary downturn. True enough, some investors do follow this advice, perceiving stocks at 30% or even more below their recent peaks as an enticing bargain, a chance to acquire assets at a significantly reduced price. However, what many fail to recognize is that this deceptive rebound is often what is known in financial circles as a dead cat bounce, a fleeting recovery that often engenders false hope among investors. This phase is invariably one of the most perilous because it can mislead even the most cautious, giving a false sense of security. It tempts investors who are currently sitting on paper losses to believe that if they simply hold on a little longer, their portfolios will eventually bounce back to previous highs. Equally, it can persuade those who sold off assets earlier in the downturn that they should re-enter the market, convinced that the worst is over. Beneath this superficial stabilization, however, the real damage is quietly spreading throughout the financial system. Banks, for instance, are quietly recording losses. Although these losses are not yet visible on the surface, they are indeed accumulating. The core issue lies in the loans extended to finance stock purchases. Many borrowers cannot repay these loans once the market declines further. As a result, banks are absorbing these losses in the background, often without immediate public acknowledgement, while simultaneously tightening their lending standards to conserve capital. This contraction in credit begins to have tangible effects on the broader economy. Businesses start feeling the pinch as access to affordable financing diminishes, leading to a decline in new orders and investments. The first indications of trouble appear as companies begin to lay off workers, and by the end of the year, perhaps around December, the unemployment rate begins to increase. Not dramatically, but noticeably enough to raise concern. This rise in unemployment has a domino effect. Those who lose their jobs face difficulties in making mortgage payments, car loans, and other financial commitments. Defaults start to rise, and banks experience mounting losses, setting the stage for an economic downturn. Despite these warning signs, most ordinary investors remain unaware of the fragility beneath the surface. Their attention is still fixated on the apparent stabilization of the stock market. Many believe that the crisis is confined solely to Wall Street, and that Main Street remains unaffected. This misperception is dangerous because the financial tremors are already spreading into the real economy. Once this economic weakening becomes evident through declining earnings and rising unemployment, the positive feedback loop kicks in, causing the stock market to tumble once again. A critical detail often overlooked is the harsh reality faced by those who bought during the initial dip in late November or December of a given year, say, for example, 1929. These investors, thinking they had secured a bargain at a 30% discount, watched with dismay as their portfolios were halved soon after, then halved again over the following year. By the time the decline concluded, some had suffered losses ranging from 80 to 90% of their investments. The lesson from history is clear. Attempting to buy during the first dip of a downturn is one of the most costly mistakes an investor can make. The initial correction might be significant, but it almost never marks the end of the decline, especially in scenarios involving leverage unwinding. Looking ahead, the period between December of 2025 and January of 2026 is likely to unfold in a similar pattern. After the stock market initially crashes in late 2025, perhaps in November or December, there may be a brief period of stabilization, even a rally, possibly a 10 to 15% rebound from the lows. During this phase, financial media outlets will claim that the market has bottomed out, framing the correction as merely a temporary fluctuation and asserting that the economic fundamentals remain strong. CEO interviews will be broadcast, sounding confident, while analysts issue optimistic buy recommendations. Retail investors, hearing this positive narrative, will be urged to see this as a once-in-a-lifetime opportunity, leading many to buy into the rally. However, this optimism is premature. The underlying circumstances are deteriorating. Banks are tightening their lending criteria, credit is shrinking, companies are reducing their expenditures, layoffs are starting to mount, and the possibility of a recession is becoming more apparent. When earnings fail to meet expectations, when unemployment begins to escalate sharply, and when economic data turns overtly negative, the market will likely reverse course again and decline. This phase of false hope and brief stabilization effectively becomes a trap that spans roughly the second and third months of an expected 18-month downturn. Investors who buy during this rally, believing they are catching a bargain, will find that over the course of the following 12 months, their positions may be cut in half once more. A key indicator to monitor is the so-called failed rally. When the market attempts to bounce back by 10 to 15% but then stalls, unable to make new highs and starting to drift lower, it signals that the dead cat bounce has finally concluded. This pattern marks the end of the temporary recovery and foreshadows a more sustained downward phase. Recognizing these signs in advance can be crucial for investors aiming to avoid the most devastating part of the cycle. This phase marks the beginning of a prolonged downturn, often referred to as the next leg downward in a declining market cycle. It is during this period that the majority of investors' wealth is systematically eroded, not suddenly wiped out by a dramatic, catastrophic crash, but gradually chipped away through an unrelenting, slow, and steady decline. This persistent downward movement saps confidence and stamina, draining the psychological resilience of even the most seasoned investors. Instead of experiencing a sharp, overt crisis, the market slips quietly, creating a sense of stagnation or a prolonged malaise that feels almost worse because it drags on without definitive resolution. By January of 1930, the stock market had already fallen roughly 35% from its all-time peak. Yet, at this point, the atmosphere does not resemble panic or chaos. Rather, it feels more like an exceptionally challenging year that everyone hopes will be followed by recovery. People cling to the belief that the worst is behind them and that the year 1930 will mark a turning point for better times. Unfortunately, this optimism is misplaced, as the decline continues month after month, gradually undressing the market of any semblance of composure. In the early months of the year, the market declines persist with relentless persistence. In February, it drops an additional 5%. In March, another 3%. And in April, there's a modest rebound of about 2%, yet it soon reverses. Then, in May, the decline deepens again by approximately 7%. June sees a further 10% slide. The relentless nature of these drops steadily erodes hope, making the psychological impact devastating. Each time investors believe that the market might be stabilizing, it plunges again, crushing their confidence. Any attempted rallies, no matter how small, quickly fade into uncertainties, eclipsed by an avalanche of negative news, worsening economic indicators, and a pervasive sense of loss. Compounding the distress are the deteriorating economic conditions. Unemployment, which had been remarkably low at around 3% in 1929, begins climbing sharply, reaching around 8% by mid-year. Factory output shrinks by about 20%, and commodity prices collapse, leaving farmers unable to sell crops at prices that cover their costs. As a result, wages are slashed, and even companies that continue operations are forced to reduce employee pay to avoid layoffs. The financial system is not immune to this downward spiral. Bank failures commence, initially affecting regional, rural, and small-town banks rather than the major financial institutions. In the first half of 1930, more than 600 banks shutter their doors, leaving depositors wiped out completely. Without the safeguards of the Federal Deposit Insurance Corporation or any form of deposit insurance, all funds stored in these banks vanish instantly when a bank collapses. This sudden loss of savings sparks panic within local communities. Faith in the safety of bank deposits erodes rapidly, prompting individuals who still have money saved to withdraw their funds en masse, an understandable instinct to preserve what remains. But this mass withdrawal creates an even greater crisis. When many patrons pull their cash at once, even the most solvent banks find themselves unable to meet the demand. Most of their funds are tied up in loans, investments, and other illiquid assets, leaving insufficient cash on hand. The consequence is a cascade of failures, igniting fear and instability. By June of 1930, the Dow Jones Industrial Average has fallen to about 220 points, roughly 42% below its peak, and the realization takes hold among investors that this isn't merely a market correction, but something far more destructive in scope. Symptoms of the deepening crisis become more apparent, yet the full extent of the devastation remains hidden, lurking beneath the surface. What makes this phase especially harrowing is the persistent and crushing hope that keeps getting reinforced, only to be shattered again. If the decline had been sudden, a rapid crash that kept the market down indefinitely, people could have begrudgingly accepted it and moved on. But the slow, grinding decline, characterized by constant false dawns and repeated failures of rallies, eats away at people's mental resilience. Investors holding positions down 30, 40, or even 50% refuse to sell, clinging to the hope that the market will rebound someday. Although in reality, the recovery remains elusive. They observe their neighbors losing jobs, see local businesses shuttering their doors one after another, and hear about further bank failures, yet they continue to hold on to their investments with almost desperate hope that things will turn around. This pattern of slow but relentless decline extends through months 4 to 9, that is, from January through June of 1936, mirroring the early days of the Great Depression. During this period, the market continues to slide gradually, not crashing in sudden waves, but rather steadily descending, with each month setting a new, lower low. Every rally falters, and economic indicators worsen as time progresses. Unemployment climbs from around 4% to nearly 7%, and eventually reaches 10%. Corporate earnings consistently miss expectations quarter after quarter. Large corporations announce layoffs involving thousands, sometimes tens of thousands, of employees, further fueling the economic despair. Banks, many of which are regional or smaller institutions, begin reporting losses, writing down loans secured by commercial real estate or corporate debt. Some banks in less prominent cities start failing, and as their names appear in headlines unfamiliar to most, a growing sense of unease permeates the financial landscape. Each financial setback, however significant or seemingly disastrous it might appear at the moment, tends to foster a growing sense of anxiety and paranoia among individuals regarding the stability of their own savings and banks. This collective apprehension often intensifies during times of crisis, prompting concerns about the safety of one's financial deposits and the future of financial institutions overall. In response to such fears, the Federal Reserve, the central bank of the United States, will inevitably undertake a series of interventionist measures aimed at stabilizing the economy and restoring confidence. Historically, these measures include slashing interest rates, initiating or resuming large-scale asset purchase programs, commonly known as quantitative easing, QE, and deploying extensive monetary support through the printing of trillions of dollars to flood the economy with liquidity. These steps mirror the strategies employed during major crises in 2008 and 2020, when economic turmoil prompted unprecedented monetary easing. Yet, despite these massive efforts and injections of capital, the underlying issues remain unresolved, rendering such interventions largely ineffective in restoring growth or stability. The core problem, in fact, is not a shortage of available money or liquidity, the so-called cash on hand. Instead, the fundamental challenge lies in an overwhelming burden of debt accumulated over years and decades. When virtually every individual's financial balance sheet has been eroded by over-leverage and excessive borrowing, the traditional tools of monetary policy, such as lowering interest rates or increasing money supply, lose their effectiveness. In this situation, attempting to stimulate economic activity becomes akin to pushing on an unresponsive string. No matter how much effort is exerted, the desired outcome, growth or recovery, fails to materialize. Looking ahead to the near future, by the middle of 2026, it's plausible that stock markets could experience declines ranging from approximately 50 to 60% from their all-time highs. Major indices like the Dow Jones Industrial Average and the Standard & Poor's 500 could be halved in value. Such a collapse would wipe out trillions of dollars in market capitalization, representing an immense loss of wealth for individual investors and institutions alike. Despite this dire prospect, a staggering number of retail investors, ordinary people who have been steadily contributing to their retirement accounts, may continue to cling to hope. They might still hold on to their investments, convinced that markets will eventually rebound, even as they witness their retirement savings being sliced in half, their overall net worth shrinking dramatically, and years of accumulated savings vanishing before their eyes. Throughout this period, emotional and psychological fatigue will take a toll on these individuals. The repeated downturns and mounting losses can leave them exhausted, demoralized, and mentally drained, perhaps even to the point of despair. But this sense of inertia often sets the stage for a more rapid and severe descent, signaling the onset of a critical phase in this unfolding crisis, one that could be even more destructive than the prolonged downturns experienced earlier. Drawing a historical parallel, consider the stock market in July of 1930. For nearly 9 months prior, the market had been steadily declining, a process that sapped the endurance and hope of countless investors. By that point, people were exhausted and emotionally drained, believing that the worst was behind them. But then, unexpectedly, the decline accelerated sharply. In July, the Dow Jones fell by approximately 15%, in August, another 12%, and in September, a staggering 18%. This wasn't just a slow and grinding correction anymore. It became a full-blown collapse. The rapid deterioration resulted from forced liquidation, where investors and institutions, desperate to raise cash or cut their losses, started selling assets in large volumes. Individuals who previously held onto their stocks, hoping for a recovery, finally succumbed, deciding to sell their holdings at any cost. Meanwhile, mutual funds and investment trusts, which faced escalating redemption requests from anxious investors, were compelled to liquidate their positions quickly. Banks, also in need of liquidity, sold off their stock portfolios, while insurance companies, facing mounting claims and payouts, did the same. The panic was contagious, and everyone was selling, no one was buying. When supply vastly outstripped demand, prices plummeted to unprecedented levels, causing bid-ask spreads. The difference between the highest price a buyer is willing to pay and the lowest price a seller will accept to widen dramatically, sometimes to absurd proportions. In such a distressed market environment, an investor seeking to sell 100 shares might find the bid, the highest price a buyer is willing to pay, at 20% below the last trading price. Sometimes, they would have no choice but to accept this lower bid because waiting could lead to even steeper losses. The next day, the price might drop 30% below the previous level. By November of 1930, the Dow Jones had fallen to approximately 180 points, representing a decline of over 53% from its peak. Yet, the crisis was far from over. In December, the market experienced yet another brutal wave of selling. Typically, during the holiday season, periods traditionally associated with optimism and festive cheer, the atmosphere was bleak and foreboding. Retail stores were emptier than usual. Shopping for gifts had taken a backseat to mere survival. The economic decline intensified, leading to an increasing number of bank failures, over 1,000 in the year 1930. Such widespread collapse meant that countless communities lost their savings. Wholesale businesses faced closure due to depleted deposits, and the local economies ground to a halt. This erosion of trust in the financial system created a destructive feedback loop. Bank failures caused businesses to fail, which in turn led to more layoffs, mortgage defaults, and additional bank losses. This devastating cycle, often referred to as a doom loop, exacerbated economic deterioration. By January of 1931, unemployment had skyrocketed to 15%, meaning approximately 1 in 6 workers was unemployed, while industrial production had plummeted by nearly a third from its previous peak. Steel mills operated at only 30% capacity. Auto manufacturing plants shut down completely. Construction projects were abandoned entirely. The entire economy was spiraling out of control, descending into freefall. The hardship was visible everywhere. Long lines snaked through the streets, as starving families queued for bread in urban centers. Charitable organizations and churches were overwhelmed by the influx of people seeking aid. Entire encampments of homeless individuals began to emerge, living in makeshift shanties and tents after losing everything they once owned. These encampments became known as Hoovervilles, a somber reminder of the depth of despair gripping the nation. Entire communities, once thriving with activity and commerce, now existed in crisis, their populations decimated by loss, hardship, and a relentless economic descent. The social fabric of society is steadily unraveling, and the financial markets serve as a mirror reflecting this growing sense of despair and uncertainty. The path of economic decline becomes painfully clear when we examine historical data. In February of the year 1931, the Dow Jones Industrial Average plummeted to a level of approximately 160 points, representing a staggering decline of 58% from its all-time peak. By March of that same year, the index had managed to stabilize on that lower level, marking a crucial point in a long and arduous descent. This period marks an 18-month interval since the stock market had reached its zenith in September of 1929, a clear milestone indicating that most of the substantial damage had already been inflicted. The decline of 58% was severe, yet it stopped short of the market's final low, which would eventually occur in 1932 at 41 points, amounting to an overall loss of around 89%. By March of 1931, the drastic redistribution of wealth had largely run its course. The individuals and institutions who had been forced to sell their holdings during the tumultuous sell-offs had done so already. Meanwhile, those fortunate enough to possess liquid assets and ample cash reserves had been actively buying up assets at sharply discounted prices, sometimes 50, 60, or even 70% below previous values. Consequently, the wealth that had evaporated from the balance sheets of the middle class, the small investors, and the everyday savers was largely transferred into the coffers of the well-positioned and financially robust elite. Historically astute investors like Joseph Kennedy, who had begun accumulating assets before the market crash, actively expanded their holdings throughout late 1930, enabling them to multiply their wealth several times over by the middle of the 1930s. The same pattern repeated itself with prominent figures such as Bernard Baruch and the venerable families like the Rockefellers and Mellons. These established financial dynasties weren't buying at the peak of the bubble. Instead, they were accumulating wealth at the market's trough. This strategic positioning during periods of despair is what enables generational wealth to be built and preserved. It's a classic example of how the most enduring fortunes are made, not by riding the waves of a booming bubble, but by having cash ready when those bubbles burst. One can visualize this entire process unfolding from late July, specifically between the 20th and 26th, through the months ahead into March of 2027. The pattern involves a rapid acceleration of decline, the widespread capitulation of investors, and the moment at which everyone clinging to the hope of a recovery finally throws in the towel. This pivotal point acts as a catalyst, triggering more selling, which in turn drives prices down even further, an unsettling cycle of panic selling feeding on itself. Unemployment rates during this downturn are expected to soar to somewhere between 12 and 15%, with corporate bankruptcies surging at an alarming rate. Major corporations, once icons of prosperity and stability, will either cease operations or be acquired at fraction of their previous value. Already, companies like Sears and J.C. Penney have fallen victim to this brutal process. But the scope of destruction will be far more extensive, extending to firms whose names are so large and established that their failures seem unthinkable. These are the titans whose collapse would send shockwaves through the entire economy. The banking sector will not escape unscathed either. Entire clusters of banks will fail, not just isolated cases, numbering into the dozens. The crisis will overwhelm the Federal Deposit Insurance Corporation, which currently holds roughly $130 billion in its deposit insurance fund. Yet, insured deposits across the banking system amount to over $10 trillion, an almost incomprehensible figure. If a mere 2 to 3% of banks were to collapse, the insurance fund would be entirely drained. Unfortunately, this means that some depositors, despite having insured accounts, could still face losses, adding yet another layer of distress to the unfolding turmoil. The social and political repercussions of such a widespread financial collapse will be profound and far-reaching. Public protests, widespread unrest, and demands for radical changes are inevitable. New populist movements, both on the political left and the right, will emerge, challenging the existing establishment and shaking the foundations of political stability. The entire political landscape will come under immense pressure, mirroring the chaos and uncertainty engendered by the economic crisis. Stock markets will serve as a barometer of this upheaval, reflecting the turbulence and unrest permeating society. Looking ahead to the year 2027, exactly 18 months after November of 2025, the anticipated decline will be staggering. The Dow Jones Industrial Average, which has already suffered significant losses, could fall by roughly 60 to 70% from its peak. The S&P 500 index might experience a destruction of value amounting to approximately two-thirds. Individual stocks, including some of the most well-established companies, could see their prices plummet by 80 or 90%, some even to zero, erasing trillions of dollars of wealth. It is crucial to understand that this wealth isn't simply vanishing. It is moving swiftly from those who are forced to sell into the pockets of those who are well-positioned to buy during these catastrophic times. The transfer of riches will occur across all levels, ranging from ordinary retail investors to large institutional players, from middle-class wealth to the holdings of the ultra-wealthy. This pattern of boom and bust of wealth transfer during market crashes harks back to the events that unfolded between 1929 and 1931. And the same sequences of behavior are poised to repeat from 2025 through 2027. The countdown to this inevitable upheaval has already begun, with roughly 18 months remaining. At this moment, in November of 2025, we find ourselves standing at what can be likened to the critical point of September of 1929, the prelude to collapse and chaos. Allow me to clarify the reasons behind this comparison. One of the clearest early signals, serving as a precise indicator that a cascade of destruction is imminent, is the record-breaking level of insider selling, executives and company directors rapidly liquidating their holdings. Over the past half-year, insider sales have far surpassed purchases by a ratio of 20 to 1. This is the highest such ratio recorded since 1907, just before the last major market crash, serving as a stark warning of the mounting internal distress within corporate America. The landscape of the current financial environment is populated by discerning investors and market insiders who possess an exceptional understanding of their domains. These individuals don't merely watch headlines or follow market trends superficially. Instead, they are capable of analyzing and interpreting the actual numerical data behind the scenes long before such figures become publicly disclosed or widely recognized. They scrutinize the real-time metrics, the concrete reports, and the subtle shifts in valuation metrics, enabling them to determine whether current market valuations are justified or inflated. Their strategy isn't centered around speculative bets or haphazard diversification, but follows a disciplined pattern of systematically reducing their holdings of substantial positions when the indicators signal overvaluation or impending downturns, effectively a process of calculated liquidation. This approach mirrors an intuitive yet strategic judgment, where large-scale selling is driven not by immediate tax considerations, but by a clear assessment of risk, timing, and opportunity. One compelling signal in this context comes from the monumental cash reserves accumulated by key investors, exemplified by Warren Buffett's recent move to bolster Berkshire Hathaway's cash holdings to an unprecedented level. Currently, the cash equivalent in Berkshire Hathaway's portfolio stands at a staggering sum of over $325 billion, an all-time high, both in absolute value and relative to the total assets of the conglomerate. This excess constitutes at least a quarter of Berkshire's entire net worth, now held predominantly in short-term Treasury securities. Notably, Buffett has not been in a hurry to deploy this enormous liquidity. In fact, during the years of 2023 and 2024, he sold off stocks worth approximately $100 billion and significantly reduced his holdings in key companies such as Apple by a remarkable 60%, and also divested shares of Bank of America. Despite this sizable cash pile, he has not been making any major new investments, which raises the question, what is he waiting for? The logical answer points to an anticipated downturn, what many refer to as a market crash, aiming to capitalize on fire sale prices that tend to follow when panic selling emerges. Buffett's historic pattern has shown that during crises, he seizes opportunities to acquire sound assets at prices that reflect distress, just as he did in 2008 and 2009 when he bought stakes in Goldman Sachs and Bank of America during the depths of the financial crisis, at prices that provided exceptional returns with investor-friendly terms. This disciplined patience indicates a deliberate strategy of waiting for the right moment to act, rather than rushing into the market indiscriminately. Another critical alert comes from the realm of margin debt, which, while not yet reaching its worrying peak, is steadily approaching levels historically associated with market downturns. Currently, the margin debt sits around 7.9% of the gross domestic product, just shy of the 8% threshold that historically has often signaled imminent crashes. Back in 1929, the margin debt reached precisely 8% of GDP in September, and the ensuing crash arrived within the following month. Similarly, in the year 2000, margin debt climbed to approximately 8.5% of GDP by March, a signal that was soon followed by the stock market decline that began in April and intensified in October. Presently, we are hovering near this critical boundary, and given the mathematical nature of leverage, it acts as a trigger, an automatic process where, once investors are highly leveraged and prices begin to dip, forced selling accelerates, turning a temporary downturn into an unconstrained decline. Valuations further reinforce a cautionary outlook. The Shiller price-to-earnings ratio, a long-standing metric that compares stock prices to the average earnings over the past decade, currently registers at roughly 35, far above the historic mean of about 16. Historically, whenever this ratio has soared past 30, it has been a precursor to significant price corrections. For instance, during the market crash of 1929, the ratio peaked at 33 before the fall, and during the dot-com bubble in 2000, it reached an even higher 56, though that's outside our current context. Our present level of 35 signals that investors are paying an excessive premium for every dollar of earnings, effectively pricing in decades of perfect, uninterrupted growth. Any disruption, be it a recession, geopolitical instability, or unforeseen economic shocks, could cause valuations to plummet almost immediately because they rest on overly optimistic expectations. Adding to the ominous picture are the soon-to-be-revealed economic indicators that are showing clear signs of slowing down. Recent data indicates that gross domestic product growth for the upcoming third quarter of the year 2025 languished at only about 1.8%, falling short of projections. Manufacturing Purchasing Managers' Indexes have been in contraction territory for 3 consecutive months, remaining below the 50 mark that demarcates expansion from contraction. Commercial real estate markets are deteriorating rapidly, Defaults on mortgages in major cities are escalating as remote work has left many office buildings underutilized and unable to refinance at prevailing rates. Property owners are surrendering properties to lenders in droves, resulting in losses for regional banks that are holding these loans. Already, 3 regional banks have failed in the first half of the year 2025, and more failures are expected as the economic stress deepens. This divergence between the weakening underlying economy and the persistently high stock prices recalls the situation of late 1929, when corporate earnings had peaked just a few months earlier in the second quarter. Currently, earnings in the third quarter of 2025 appear to be flattening, with revenues slowing, profit margins narrowing, and companies beginning to issue downward guidance for the upcoming quarter. Though stock prices remain elevated, these fundamentals suggest that the market has priced in growth that is increasingly unlikely to materialize. The disconnect hints at a potential corrective phase that may sharpen once investor sentiment adjusts to reality. Speaking of sentiment, the prevailing mindset among many investors remains overly optimistic, so much so that most believe equities can only ascend and that any subsequent crash is impossible, as central banks, especially the Federal Reserve, will always intervene to stabilize markets. This widespread complacency, built on the assumption of eternal support from monetary authorities, masks the inherent vulnerabilities of the system. When a critical mass of investors shares this belief, and coupled with high leverage and inflated valuations, the stage is set for a sudden and potentially severe correction should confidence waver or external shocks occur. This period we're experiencing now is fundamentally different from previous moments of economic euphoria, yet many still believe that the soaring valuations of AI and technological innovations fully justify current market prices. That confidence thrives on the assumption that these cutting-edge developments somehow negate traditional risk factors. However, this unwavering certainty parallels the mindset prevalent just before the catastrophic crash of 1929, with many investors convinced that the clouds gathering in the sky were no cause for concern. The same reckless disregard for potential downturns persists today. Just as then, people point to record highs in the stock markets, the strength of the overall economy, and historically low unemployment levels, confidently asserting that everything remains perfectly fine. Yet, history vividly demonstrates that such complacency is perilous. The same mixture of optimistic assertions and dismissive attitudes about risk accompanied the lead-up to the infamous Black Tuesday, just 3 weeks after the peak of September 1929. The current situation closely mirrors that moment, and unless history repeats in an entirely different manner, the impending crisis is likely to unfold within the next 30 to 60 days, most probably in November or December of this year, 2025. From that point, an 18-month countdown begins, culminating around March of the year 2027. This timeline is crucial for understanding what approaches and how to navigate it. To prepare for this impending upheaval, it is essential to follow a strategic plan divided into 4 deliberate phases. The first phase, spanning from November to December of the current year, represents the final window to significantly reduce your exposure to risk before the market's anticipated crack. If you find yourself heavily invested, say, holding 70, 80, or even 90% of your assets in equities, it's the moment to reassess and scale back. While I'm not advising you to completely liquidate your positions, lowering your holdings of stocks to not more than 50% or less will serve as a critical shield against the anticipated 40, 50, or even 60% downer. This is also the time to consider taking profits on investments that have appreciated substantially. Moving assets into cash or short-term treasury instruments is a prudent move to safeguard your capital. Yes, it's possible that markets may continue their upward trajectory into December, earning you a few percentage points in gains, but these modest returns pale in comparison to the risk of facing a severe decline. The math overwhelmingly favors de-risking now, especially given the historical pattern. Exposure now is akin to playing financial Russian roulette with a high-caliber gun. For those of you who have bet on highly speculative stocks, those that have doubled or even tripled in value within the past 2 years, it's time to consider liquidation. This category includes technology companies with no earnings, meme stocks that are driven by hype rather than fundamentals, SPACs, or any other investments trading primarily on narratives rather than solid financial grounds. These assets have the greatest vulnerability to collapse, and history shows that they are the first to fall sharply. Remember, in the 1929 crash, RCA stock plummeted by a staggering 97%, and countless speculative stocks virtually disappeared, dropping close to zero. At this stage, an additional protective measure would be wise: purchasing options as insurance. Specifically, you could buy put options on leading indices such as the SPY or the QQQ, with expiration dates set for 6 to 12 months ahead. Allocating around 2 to 3% of your overall portfolio to these puts provides a form of financial insurance. If the market crashes by 50%, these puts could yield returns of 10 to 20 times your initial investment. On the other hand, if the markets hold steady or rise, you merely lose the premium paid, akin to buying an insurance policy you hope never to need. But should a significant decline occur, this hedge can dramatically limit your losses. Moving on to the second phase, spanning December 25 to January 26, you will encounter what I call the crack and the false hope. When the first major correction manifests, perhaps a 10 to 15% drop within a week or two, resist the temptation to buy the dip. Everyone will likely interpret this decline as a buying opportunity, but that would be a mistake. It's only the first chapter of what will be an 18-month saga of turmoil. During this period, every financial news outlet will feature experts claiming that the fundamentals remain strong. They will dismiss the decline as a simple correction and encourage investors to buy the dip. History warns us otherwise. Similar narratives were pervasive in October 1929, right before the market further collapsed. When the market eventually stabilizes and experiences a rally of 10 to 15% in December or January, many will believe that the bottom has been reached and that the worst has passed. However, this rally, what some might call a dead cat bounce, is merely a false recovery, a temporary rebound that lures investors into a false sense of security. Do not be deceived by this rally. Use it as an opportunity to sell any remaining assets that you haven't yet liquidated. The next leg downward is inevitable, and the true depths of the decline are yet to come. The third phase, from February through June of 2026, will be characterized by a relentless grind downward. This period will demand extraordinary mental resilience, as each month may bring fresh lows. Every attempted rally will fail, and the economic outlook will grow more grim. The media will focus on worsening conditions, more layoffs, failing businesses, declining consumer confidence, adding to the overall sense of gloom. Amid this environment, the natural instinct might be to buy stocks because they seem cheap or to believe the worst has already been priced in. Resist this temptation. Patience and steadfastness are needed now more than ever, as impulsive actions could worsen your position. Throughout this prolonged downturn, maintaining a disciplined approach is critical. It's important to stay calm, avoid impulsive buying or panic selling, and recognize that markets often test investors' resolve before reaching the eventual bottom. The path will be fraught with setbacks, but perseverance and a clear strategy will help you preserve your financial well-being during what promises to be the most challenging period of the unfolding crisis. In summary, understanding this multi-phase process, the last opportunity to de-risk, the false hope rallies, and the grinding decline, provides a roadmap for navigating what's coming. Preparation, discipline, and strategic actions taken now can significantly mitigate your losses and position you to weather the storm ahead. Market prices are destined to decline further, and it is crucial not to succumb to despair or panic selling. Many investors make the mistake of liquidating their holdings prematurely, but it's vital to remain patient and composed. If you've already committed capital during the initial phase of this downturn, then your position should now be in cash, allowing the market to run its course without interference. The most challenging part of this process is precisely this: standing on the sidelines with your money uninvested while the asset prices continue to fall. Yet, this cautious approach is actually the most prudent course of action because a significant opportunity is on the horizon, what is known as the fourth phase. This fourth phase is projected to span from the month of July in the year 2026 to March in the year 2027. During this period, a market capitulation will likely occur, a dramatic decline in asset prices that will mark the moment when the true buying opportunity emerges. It will be characterized by a market decline of between 60 and 70%, a level comparable to historic bear markets. Unemployment will have surged to levels around 12 to 15%, signaling a deep economic slowdown. Concurrently, widespread fear and panic will grip investors, and the media will propagate apocalyptic headlines, amplifying the sense of crisis. Additionally, friends and family members might consider your investment plans irrational, questioning why anyone would buy stocks when everything appears to be falling apart. It is precisely during this period of intense pessimism that prudent investors should deploy their capital. But timing is vital. The strategy is to scale into positions gradually rather than all at once. Start purchasing quality stocks when the market has declined by about half, 50%. Increase your holdings further when the market drops by 60%, and add again when it falls to 70% below the prior peak. Focus on buying shares of companies with solid financial health, businesses that possess strong balance sheets, minimal debt, and essential products or services. These are enterprises like Apple, Microsoft, Visa, Johnson & Johnson, and Procter & Gamble. Companies that are resilient and capable of enduring economic downturns, with prospects to survive and prosper over the long term. By acquiring these assets at 50 to 70% discounts from their all-time highs, investors engage in a critical transfer of wealth. At this point, financial resources shift from those forced to sell during distress to investors who are positioned to benefit from the recovery. If you have sufficient cash reserves and the courage to act while others are still selling in terror, you position yourself for exceptional long-term wealth accumulation. History offers countless examples. Those who bought during the depths of the 1931 and 1932 crashes amassed enormous fortunes over the following 2 decades. Their descendants inherited this wealth, enabling their grandchildren to enjoy financial abundance today. Similarly, purchasers who entered the market in 2009, following the financial crisis, reaped extraordinary returns, over 500% in the decade that followed, as exemplified by a simple investment in an S&P 500 index fund made in March of 2009. Looking ahead, the investors who brave the market in 2026 and 2027, after this inevitable downturn, will have the opportunity to generate extraordinary wealth during the subsequent decade. However, it is essential to survive the period of chaos. You must de-risk your portfolio now, safeguarding your capital through the storm, and muster the courage to buy when everyone else is selling out of fear. The time frame for these developments is approximately 18 months. History shows that from the onset of the downturn, stage 5, until the point where most wealth is eroded, the 18-month mark, is roughly this length. For example, from September of 1929 to March of 1931, most of the losses occurred. Currently, as of November of the year 2025, we are at a similar point in the cycle, akin to the September 1929 moment, meaning that by March of the following year, the market will likely have declined by 60 to 70%. At that time, most retail investors will have seen their wealth evaporate, and the transfer will largely be complete. Wealth will have shifted from those forced to sell in panic to those who had the foresight to hold or buy. This is not a matter of clairvoyance. It is pattern recognition, identifying the recurring signals, familiar stages, and mathematical trends. The reality is that mathematics executes without bias, regardless of optimism, hope, or belief. If you recognize the signs early, you can position yourself advantageously. If not, you risk being caught off guard. You have a choice. Either align yourself on the side of the transfer that benefits the prepared and courageous, buying at substantial discounts, or remain on the wrong side, forced to sell at steep losses. In either case, time is limited. Each day that passes narrows your window to act effectively. If this analysis resonated with you and helped clarify what's coming, I encourage you to follow this pattern closely over the next 18 months. I will be tracking the progress month by month, providing insights on where we stand along the timeline, what indicators to watch, and when the optimal moments to act will arrive. You certainly won't want to let these updates slip past you, as they could very well determine whether you manage to withstand the impending financial upheaval or fall victim to its devastating impact. Staying informed during such critical moments is essential, as timely insights might mean the difference between merely weathering the storm and being overwhelmed by it. By keeping yourself up to date, you increase your chances of navigating through turbulent times with greater confidence and clarity. If you're seeking a deeper level of analysis, one that goes beyond surface-level observations, covering specific stocks, precise timing, and professional investment strategies, you might consider joining as a channel member. Such membership offers access to more detailed insights and tailored advice designed to help you make well-informed decisions amidst volatile market conditions. The link to become a member is provided below for your convenience. Looking ahead, the pattern suggests that in approximately 18 months from now, most of the significant damage inflicted by this financial downturn will have already occurred. This means that the worst may be yet to come, but the majority of the destruction will likely be completed within that time frame. The crucial question now is whether you will have managed to survive this period intact or find yourself overwhelmed and ultimately destroyed by the economic upheaval. As we approach this pivotal juncture, your ability to adapt and respond effectively will be tested most. The window of opportunity to prepare and safeguard your assets is closing rapidly, making it more important than ever to stay vigilant and informed. I will see you on the other side of this challenging phase, equipped with the knowledge necessary to emerge resilient and ready for what comes next.